Hello, everyone, and thank you for coming. Thank you for joining us this afternoon, and thank you to the organizers for a fantastic day. Today we'll talk about how tokenization will redefine capital markets and payments. And we'd like to start the discussion moving beyond broad tokenization question and thinking more about how the tokenized products, tokenized assets, the cash leg, and the infrastructure can work together to create a real, functional, and scalable market. So the question that we want to focus on is how we can move from a collection of different tokenized products and different pilots into a scalable and real market. And I think we have enough of developments across the stack for this to be a serious market structure conversation. In the last few months, in the last year, we've seen continued digital bond issuance. We've seen Euro stablecoin development under MiCA, growing work around central bank money, more secondary market experimentation, more discussion, at least when measured, about conference buzzwords around interoperability. But we're still very much around in the transitional phase. So 10 days ago, Euroclear and Clearstream have went live with a dematerialized Eurobond infrastructure from a market of around 15 trillion. While that is about digitalization more than it is about tokenization, it shows the scale and the size of the legacy market that we'll be discussing about modernizing. In 5 days, we have the ECB's collateral eligibility decision for DLT-issued securities. And in a few months from now, we'll have the ECB's Pontus program, expecting it to take us towards settlement in central bank money. So we see that the tokenized products are here, and the question that we'll be answering in this panel is how do we move from these tokenized products to a tokenized market infrastructure? So in other words, can the asset layer, the money layer, and the infrastructural layer begin to work together in a way that institutions can actually use at scale? So let me begin by a quick round robin to all of you, perhaps beginning with Sebastien. From your perspective, what is the single most important thing that still needs to happen to tokenize assets, tokenize money, to the infrastructure, to work together as a real market?
Well, to work as a single market, there is one thing that is clearly missing still, and that is not there in the traditional markets either, is really standardization and interoperability. So a true interoperability is missing today, and without it, fragmentation will remain. Fragmentation is the enemy of liquidity. Without liquidity, you cannot have a market. So clearly that. Solve the interoperability, and that will be a big step forward for having a true market.
And if I could do a tiny follow-up, who do you think should be primarily, who is responsible for this interoperability? Is it standard bodies? Is it the market players?
Well, several initiatives have already been put forward. I'm thinking about the ICMA, who is putting the bond data taxonomy. SWIFT has done some interoperability work. Euroclear, Clearstream, and DTCC have put forward 2 weeks ago a new version of the DASCP, so that's the Digital Asset Securities Control Principles, which are key for interoperability. And actually, they have been praised for their quality by Piero Cipollone 2 days ago in the frame of Appia. So it's quite interesting. So yes, fair to say it's usually is the market infrastructure like Euroclear, Clearstream, SWIFT, or the association that are putting that forward.
Guillaume?
No, I just wanted to agree, actually, with Sebastien. I think the most important is really a convergence towards a common market infrastructure. As you said, there's a lot of fragmentation today. We see there's a lot of pilots, nothing really at scale on different stack, and more importantly, there's a lot of assumptions about legal structure, privacy, permissioning, etc., and there's nothing standard for the time being. So there is a real question is how are cash, or digital money, digital assets, collateral and functional flows are going to be operating in a repeatable way, but also, even more importantly, under the supervision of the regulators. Nothing's going to happen without the regulators.
And when you're talking about regulators, do you mean how securities are regulated within national laws at the European level, or about MiCA and the kind of centralized way of regulating that?
I was more thinking about at the level of the ECB, and then obviously after that the local regulators, which make things very complicated. But just to finish with this, I think when we talk about market infrastructure, we're just not talking about, okay, is it going to be on the layer 2 or on the... market infrastructure is also about the legal definition about a token, for instance, and as a representation of an asset. It is, as you said, the common data model that you've been working with Clearstream and the DTCC, the operating framework. It's a lot of things. It's just not that, just the layer, which is important. And as you said, the most importantly is the interoperability stack that will be defined in the future.
Thank you. Kim?
Yeah, happy to add to this. I think it's not just interoperability, but it's also integration. I think we have tokenized money, we also have tokenized assets by now, but it's really how do we get that into the value chain overall? Because like if we want to settle a fund, for example, with tokenized money, how do we do that? Does the investor already pay and the distributor accepts the stablecoin and it converts it then directly? Who does the conversion? Because currently a fund, for example, still mostly invests in traditional underlying assets. So we still have a breach sometimes. We're not fully there in a tokenized world yet. And I think as long as we operate in this like hybrid model a little bit, since not everything is on chain yet, it's mostly about integration and not just interoperability. I think that's an important aspect, but we also need to see along that value chain, how do we really integrate that in all of these processes that are still, unfortunately, mostly traditional.
Would you say that part of this integration is dependent on the demand side, that there's lots of kind of supply of different products becoming tokenized, but that there is still a lacking institutional demand?
I think it's not the lacking institutional demand. I think it's more demand is there, and then also we have a lot of supply, I would say. But I think it's like along this value chain, certain players just need to integrate it a little bit more, and that could be an asset manager, the fund itself. It needs a wallet to maybe accept stablecoins. I think in Luxembourg that was allowed recently. And then also other players, for example, on the distribution side, we just need to really see that the integration happens along that whole market infrastructure and value chain, and every participant is ready to handle tokenized money and tokenized assets. And it's not just focusing on the siloed functionality it takes.
Thank you. Michael?
Yeah, I just want to add on who is driving the standardization. I think there will be a big effect of the first players now being active. So I think the big financial institutions who are now kind of an early adopter and are entering the space, they will have a huge pull factor on the other remaining financial institutions. So I think there's if you go now into this space, you have a big power of control over how the market will look like in the future. And you also see this on a regulatory level. The countries who regulate first will also have a pull factor on other regulations by setting the standards they think should be the standard. And for example, I'm convinced we will see a big pull effect from the US now, because now the US is like heavily leaning towards the regulation of tokenized securities. And they will decide for an underlying network, DLT network. They will decide for the way it's distributed, and this will have, because I mean it's the biggest economy in the financial world, will have a huge pull factor on the rest of the world. And then there will be decided public, private, permissioned, privacy layers, and so on. I think it will be decided by the first movers.
Thank you.
I agree with a lot of what was said here. I think I would just add. I think what's missing, especially in Europe, is the cash leg, right? The euro on chain that will provide the settlement layer for all of the tokenization that's happening. And I think that's something that we still need to build, and that's something that we're trying to build with the consortium of banks we have behind us. But also, it's something that will develop over the next year to 5 years, depending on how long it takes all the other elements of the euro on-chain and digital euro and wholesale CBDC and that whole stack to develop. So I think that's something we might talk about later. But
if you had to name which one would be the most important for you in terms of thinking whether that happens in a year or in 5 years?
Well, I mean, I think if you look at where the technology is on the various types of tokenized money, if you like, right? I think you've got the stable coins, which are here now. The technology is here. It's not complicated or rocket science anymore. I think to get distribution of the euro on chain, I think that may be a little bit more complicated. But then you have stable coins, you have tokenized deposits, which is a bit further out. I think there's a lot more complicated interoperability issues there, which will take a little bit longer to resolve, I think. And then you also got the central bank tokenized money, if you like, that is also being worked on, and we'll see where that ends up. But there are also different parts of the same. I would think they're different parts of the same financial stack, right? Or money stack, if you like, right? I think you've got the wholesale CBDC, which I think, as far as we know, is not going to be on chain. It'll be on the centralized ledger. Will be, a wholesale settlement layer at some point, below the whole thing. But then you'll have. It'll kind of layer up where you have, tokenized deposits will be closer to kind of a yield instrument, and then you'll have the stable coins, which will be more of just a payment token, and also a payment token on blockchain as opposed to on some kind of centralized ledger. And so you kind of can create a whole monetary stack, if you like. I mean, as usual, Europe makes it slightly more complicated than the US, but I think we're on our way there. But it'll take time for each of those legs to develop. But I think, as I said, I think stablecoin is here now, and the stablecoins are here now and available soon, with the depth of liquidity where it will become the first part of that stack to be interesting, I think.
Thank you. So there are issues of legal robustness, of operational usability, of something that is economically worth adopting, and of all the regulatory things that we can discuss. So let me come back across the panel and go into some of these questions in more detail, coming back to Sebastien. Euroclear has obviously been positioning itself as the bridge between the traditional market infrastructure and the emerging DLT-based markets. And the FMI conversation has more recently focused on interoperability. So my question to you would be that from the market infrastructure perspective, what does it actually take to move from the promising pilots to infrastructure that functions at scale?
So I see three things that are required to move from a pilot to a scale market. Interoperability, I mentioned it, so that's very clear. That's interoperability between the DLT networks. But there is also something that is not a nice to have, but that is really important, is the connectivity, interoperability with the traditional markets. Connecting the DLT environment with the traditional environment will facilitate the transition from one side to the other. So that is an important interoperability aspect. There is another point that is very important, is the fact that this transition needs to be done together with the ecosystem. So there needs to be an ecosystem coordination on how to create this new DLT network, this DLT environment. Nobody in this room, not us, and I don't believe many of us, will be able to create the DLT market of tomorrow by himself. We will need to be, all of us, or a big chunk of us, around the table to discuss how that will be done. So that means not only the CSDs together, or only the broker-dealers together. It's broker-dealers, the CSDs, the investors, the issuers, everyone. And then the third aspect that is very important is the trust. So the markets will not move its liquidity or the bulk of the assets in a new environment that it does not trust. So clearly the trust will be key for that. If you don't have these three aspects, interoperability, co-creation, ecosystem creation, and the trust, you will remain with siloed experimentation, where you will not be able to get liquidity, so the issuance will be done. Yes, you might have a great technology that is absolutely perfect, but the issuance that you will make in those silos, these islands, will not be able to exit and be liquid. So that's the risk of having that. You will have proven the value of a technology, but you will not have created a market.
Thank you. Michael, let me bring this down to the level of live transactions and actual clients. Cashlink is working directly with issuers and banks on tokenized securities, including with Deutsche Bank, KfW. And so from that direct work, what do you think are the main practical challenges that institutions are facing in tokenized securities?
Yeah, so I'd also want to add on the picture of vision Sebastien just pointed out, and which I totally agree on. I think there's a step in the middle between what we are seeing right now from our clients, which is on the one side, yes, we have pilot transactions and great pilot transactions where the institution learns a lot internally about what the processes are and will be in the future for token-based capital markets. It's also for educating the market, showing the market you want to shape the market. And then you have the vision Sebastien just pointed out, if you have then the trust and the co-creation and the interoperability. In between, this is where our clients are now heading, is I would say siloed scalable use cases. So not siloed experimentation, but siloed scalable use cases where we see it's a very defined value chain, for example, of structured products, leverage products, which are then distributed by neo-brokers or crypto brokers, but at high volume and high scale. This is what we're going to see as the next phase in tokenization, where you have high liquidity because you're working with market makers and the underlying of the structured product has a high liquidity in the traditional world or in the crypto world. And then you will see, I think, high volumes, scalable use cases, thousands of issuances, new issuances a day, and we will see this use case pretty soon. And that's what I call it. You don't need the interoperability for this because you have a very straightforward value chain with market maker, issuer, maybe trading and settlement venue, and broker, which works at a scalable. Which works at scale. And this is the next phase we're seeing. So most of the institutions we work with, they start with educating themselves, then they move over to pilots. Usually the pilots have very manual processes. And it's not integrated into the existing systems. And now they're moving into, what I just explained, the siloed scalable use cases. Or just today we announced an issuance with DZ Bank and KfW, where they put more and more on-chain. So they tried to put more and more lifecycle on-chain. They did a smart derivatives bond contract. So the ISIN was created on-chain, and to have so many operations as possible on-chain. So this was just coming out today from DZ Bank and KfW and us. So yeah, on the one point, moving more processes and lifecycle and data on-chain, finding your siloed use cases where you have instant cost effects, efficiencies, or where you have instant new order flows coming from the crypto brokers. I think these are the phases the financial institutions are facing when we are working with them.
Thank you. Jan, one of the most useful points that I found in our prep call that we had before this was when your pushback against this kind of either or when it comes to debates around stablecoins, CBDCs, and tokenized commercial bank money in terms of having to choose one on the cash leg. Before we get to the kind of stack question, let me start a step earlier. From the tokenized money perspective, what problem does this infrastructure actually solve in practice?
Well, I mean, I think in practice, when you're talking about tokenization or talking about the blockchain with reference to any kind of financial institution or financial transaction, what you're really talking about is how does the efficiency of the blockchain in terms of time and speed and cost make that transaction faster or better or easier for the participants, right? But in order for that to really in order to get the full effect out of it, the full benefit out of it, for example, atomic settlement, you need a cash leg on chain, right? And so I would suggest that any time, if you're looking through your bank, and this is something that, I guess we found as we work with the banks in our consortium on how they're looking at digital asset strategies and so on, is they'll begin with a small idea about some little piece that they want to, where they'd want to implement the stable coin, and then they'll quickly realize that there's quite a lot of processes in the bank and financial processes that can be improved if they are put on chain but only really improved if they're on-chain if there's a cash leg on the other side of it. So, tokenization is an interesting idea, but then if the other leg is fiat, you're losing a big part of the benefit, right? Like a big part of the benefit is also the atomic settlement, which takes out or reduces counterparty risk, improves settlement times, improves settlement finality, and all of that. But again, for all of that to happen, you need the cash leg on-chain, right? And so I would suggest that any time you see inefficiencies in financial infrastructure, where one half of that process is cash on chain will become an intricate part of that transaction.
And do you think that we're talking sort of primarily about coming back to the question of the developments in stacks and in kind of narrow niches? Do you think that we're talking primarily about payments at the beginning with stable coins, or about settlement, treasury operations, or do you think that they will develop together once the infrastructure and the ecosystem and the regulatory clarity is there?
I think it's it's like a timeline, right? It's interesting talking to the people that we're talking to as we try to move these use cases forward in the consortium. Different banks have different use cases that they're interested in. Mostly around payments, and fundamentally what we're building, I guess, under the Genius Act would be considered a payment stablecoin, right? So it's an EMT, but specifically for payments because there's no yield and all of that. So you have, some of them working on cross-border payments are quite close to already, starting to think about how to actually implement that. Others are talking about, for example, issuing a bond on chain. And then settling it against a stablecoin, again, because the stablecoin is the technology that's here and ready now, versus the other sort of forms of tokenized money that are not quite ready yet, right? And so again, it really depends in terms of where in the bank that the blockchain efficiencies are going to have the biggest impact, and those are the places where right now stablecoins as the cash leg are useful and interesting.
Thank you. Kim, coming to you. From the asset management side, one of the recurring tensions is often that the infrastructure providers create what is technically feasible, but the end user cares more about what actually improves usability enough to justifying changing workflows or changing their investments. So from your perspective, what would make tokenized markets more usable for institutional participants in a way that really drives the demand forward?
I think we first need to distinguish maybe a little bit like what institutional participants or clients we talk about. There, for one instance, the traditional clients that we currently serve today, I think they don't really care about the underlying technology that much. They just want to have the efficiency gains. For example, like you mentioned, faster settlement. They maybe are interested in the 24/7 accessibility and stuff like this. So more on the efficiency side, really.
Has that changed in recent years, that they became kind of technology agnostic and before were maybe more wary of blockchain-based tokenization?
I would say we're not there yet, since we don't really have any underlying assets on chain. We're just tokenizing the fund wrapper at the moment. We are starting to have the cash leg on chain as well, but for that instance, I would say we're still having limited efficiency gains. So this is why I would not really see the traditional investors as the main target group for these tokenized products as of now, but more clients that we can currently not reach as an asset manager, which is more out of the digital asset native world, as I would call it. They hold huge amounts of stablecoins, for example, under MiCAR. They're not getting any yield on these products, and they're looking for alternative products that they can invest their money in or easily switch that are also on chain. So for example, putting a stablecoin then directly into a tokenized money market fund and then redeeming them quite conveniently and instantly again. So I think these are the cases that we need to look at, and we need to understand that client group a lot better. I think we don't serve them today, we don't really have access to them, but I think this is also what bringing tokenized products out in the market is about, really understanding these new client groups that we're currently not targeting. And this is what we're trying to do, obviously, but I think it's a long way. They're clients that we don't really reach. We have certain KYC, AML regulations. This makes it also a little bit harder because these are clients that are primarily on-chain. These are DeFi organizations, DAOs. That's a little bit hard for a traditional asset manager maybe even to onboard. So I think these are certain things that we just need to take into account when we really want to be a player in the tokenization world as well.
Thank you. Guillaume, let me bring you into the architecture question here. Consensys obviously coming at this from a different place than an FMI is coming at it with a much stronger belief in a shared programmable public infrastructure, I think. How do you see that the market architecture evolving between public chains, permissionless architecture, and some hybrid models that we discussed in the first round?
So indeed, our CEO co-founded Ethereum, but I'm going to surprise you, actually. I don't think there is a real debate between public chain, the use public chain or permission. I think the future is hybrid between the two, because we know that FMIs, they need privacy, they need permission access, they need supervisory from the regulators. They have accounting, they have requirement to audit, etc. So I don't think FMIs will ever be only on public blockchains. So it will be probably some layers just above, hopefully Ethereum, indeed, to manage all of that. I know that some banks are already moved all their cash management directly on public chain, but we know that for capital markets, which are heavily regulated, it's going to be probably something on a layer which is more hybrid than. We know on the other extreme that if it's as you were saying, actually, it's a totally private network, it's not going to work, because then we come back to the problem of fragmentation and silos, and this is really the problem we try to solve for liquidity.
And do you think that the market is genuinely converging now in those hybrid models, or are we still building kind of parallel systems that yet don't properly meet, but we can hope that there will be some solution at converging them at a later point?
Yes and no, I would say. There's several technologies and solutions in the market. You have Canton, which is very much private. So we know there will be some volumes on Canton, but also on more EVM, Ethereum. But I think the slight convergence, I think, towards more EVM infrastructure. We see that a lot of infrastructure are on Besu, which is an Ethereum client built by Consensys as well, but given to the Linux Foundation. So a lot of financial institutions are using really open source infrastructure and building on top of it. So I think there's slight convergence, but we see that sometimes that there's also the force of the lobbying, and then maybe on more private infrastructure like Canton. I just want to make a word on that, actually, because we are Europeans here in Europe, and then we need to know that I think the future sovereign infrastructure in Europe needs to be 100% European and not really backed by American banks, and some of them are my shoulders, so I'm not going to complain too much, but definitely that's going to be a requirement for the future, to have really a sovereign infrastructure in Europe.
Thank you. Mindful of time, I'll go to the second round of our questions, coming back to Sebastien. When we were talking before the panel, you mentioned Project Pythagore with Banque de France, and moving the French short-term commercial paper market of around 310 billion on DLTs. How would you think about this project in the context of our discussion? As a specific use case, some interesting project that one European country is doing, or a broader market migration trend, part of this trend?
Well, it's both, actually. It's a use case because we are targeting one specific type of paper, which is the French short-term commercial paper. But it's a market move because we are going to move the full market from traditional to DLT. So in short, what is Pythagore is the strategic initiative that has been, that Euroclear is doing together with Banque de France to migrate this full market on-chain DLT. Purpose is to be doing the first transaction by year end, and so move So it will be built ready next at the end of the year and going live really 2027. So, but we are going to move ultimately the 310 billion on chain. So everything will not be moved at once, of course. We will do that gradually, but clearly it's a market move. And coming back to what I said earlier, so why we do consider that this could be the beginning of a true market move that will be a first use case that will trigger other, it's because we are doing that in line with what I've said earlier. So interoperability, of course, we are going to build it with the principles that exist. We are going to connect it with the traditional system of Euroclear, meaning that the issuance will take place on DLT, so it will be fully digital. But if the investor doesn't want to go digital yet, we can move the token back into Euroclear, the traditional system. The ones who want to remain in DLT, no problem, you can stay in DLT, you can have the corporate actions done there, secondary market, redemption, all the life cycle of the security will be done on DLT. Then I mentioned about the importance of co-creation. This is not something that Euroclear and Banque de France are building together. Yes, we are building that together, but we are doing that together with the market. So we have more than 40 institutions, French, but also cross-border, that are participating to the discussion on how to build that. And so we have, and that's broker-dealers, IPAs, issuers, investors, the whole chain. And talking about issuers, which are very important in that frame, we have more than 16 issuers that have committed to make their issuance into this DLT, and that represents more than 50% of the market. So this could actually move quite fast.
And so if that works, and we all hoped very much that it will, does it suggest that Europe will scale tokenization market by market rather than by product, that this will happen in France, then the regulators and the markets in Germany will react, or do you think that you can scale this quickly into different other countries?
Well, the choice of what needs to be migrated will come together with the market. So we will see what is relevant to migrate. Here, the trigger was really Banque de France, who was really wanting to modernize these markets. And then it was also a way to use, because we are going to connect to Pontes for the wholesale CBDC settlements. So it was a good use case to modernize the market, to use Pontes for the settlement, to migrate a full market with. So it's actually an excellent use case to move a full market. So that's yes, but of course after that we can imagine to do the same, because it's the first step towards a bigger migration potentially, yes, for other markets. And so of course I mentioned the trust, the trust that was needed. Of course here you have Euroclear, which is currently the CSD of France, so they know us. You have the Banque de France, you have the supervisors. We are filing, David Durochou will be happy, but we are filing for the pilot regime. So it's a full thing that will potentially move indeed, that will move the market, and that might be the beginning of something much bigger. I was hearing in another panel this morning that 4 billion of securities were issued since 2021 in Europe, which was not a lot, and there was complaint. But Euroclear, with our previous DLT platform, or current DLT platform, we've issued 1.3 billion. Here we are moving directly with 300, not tomorrow, but over time.
Michael, when we were talking on before the panel, you about the kind of how to frame the problem of why hasn't this taken off, or maybe moving more into what the current challenges are, what solutions are emerging, and what are the timeframes for this. Which solutions do you think are becoming clearer in terms of maybe more institutions trusting it, or more jurisdictions having the trust that Sebastien is mentioning? And what time frame do you see those frictions easing? Is it in terms of further Pontes work, and by then we'll have something if we see a kind of European bank-endorsed CBDCs, or what do you think is the likely time frame in the next couple of years?
Yeah, I think the key driver in the last years was regulation, We saw this in Europe, we saw this in the US, so this was the door opener for the financial institutions to tap into tokenization. So we can say, okay, check here, regulation. I mean, there's still things to improve and adjust, but basically the regulation is here. And now the financial institutions are entering the market, and the big financial institutions, I think, are mainly driven by, on the one side, cost efficiencies, but on the other side, there's a new value chain, and they now can enter or can control parts of the existence of the security, the register security, which has formerly been controlled by the CSDs. So we see big European banks now really looking at this space and saying, okay, how can I internalize the part of the value chain which has been formerly done by the CSD? And so it's a short-term cost case. Obviously, in the long term, it has way more, the potential is way bigger. And on the money side, yes, I think right now when I look at what our clients tell us, they're looking at Pontes, Appia, they're looking at the stablecoins with the consortium, they're looking still free of payment will also be a big part of the use cases. So I think here it's not really decided which method will prevail and in which use cases. I think everyone is still placing their bets. And what we see this year is really, I think, the crypto brokers, the neo brokers, the fintechs in the security space, they will really implement scalable use cases. And the big financial institutions this year, I think, will still be a lot of POCs, and it will still be first siloed use cases in money market funds, in structured products, and in bonds. And then it will gradually, I think it will gradually get more and more. But on the neo-broker side, it will get exponentially more. So, and this we'll see very soon. And just one remark here, if you see how the US companies are positioning themselves in Europe, so last year we had 3 M&A transactions in the tokenization space. So Swarm got acquired by Invenium, a US company. Tokeny got acquired by Apex, a US company. And Backed got acquired by Kraken. So what's basically happening is that US companies are already buying the future capital market infrastructure of Europe already now. So that's why sometimes here on the panel I'm asking, is tokenization a trend? Will it kick off? Whereas the US are already buying the market at cheap prices compared for them. And I think this is something, if you look at it, there will be huge consolidations, I think, in the next years. And then we will see who the new market will look like. And I think consolidation and standardization is not something you can force top down, apart if you're the regulator. Otherwise, the market will set the standards by themselves, kind of by who is the biggest and the most powerful.
Guillaume, do you think that there is anything we can do to protect the European market from this kind of buyout?
Well, I can come back to what Sebastien said earlier. I think trust will be given by ECB at a later stage. Co-creation, I think the CSDs, with all the respect for the banks, and I've been a banker for 20 years, so they're going to be more followers than leaders, and I think there's a huge opportunity for Clearstream, Euroclear, Euronext, all the infrastructure in Europe to co-create that potential layer under the supervisory of the supervision of the ECB, and then the interoperability will move along, I think.
But Jan, what do we do if those same banks that are in the consortium trying to drive this effort probably also have strategies which are probably also investing in US-backed stable coins and similar market infrastructures to that? How do we solve that problem?
Actually, one of the drivers of the consortium and one of the reasons why we're even trying to build this is, European monetary sovereignty, right? And I think what I was saying earlier about, the blockchain bringing a lot of benefits and so on to financial markets. If you follow that thought through, right, then you start to move a lot of this stuff on chain. If we don't have a euro on chain with sufficient depth of liquidity in some form to make that work, you're going to end up using dollars, right? Because that's where the market is. And that is a real threat to European monetary sovereignty, I think, and I think the ECB has recognized that as well. I think that's part of the reason why maybe they've softened their stance a little bit on stable coins and on other elements of the monetary stack. And I think that's where we have to go, right? We need to build, and this is what we're trying to build, a euro on-chain by Europeans for Europeans.
Problem is timeline, if I may, because we've been talking about Pythagore, which is great, Pontes, which is based on Banque de France infrastructure, but Appia, I think the timeline for Appia is like a 2028, 2029, and to your point, but then the US will have both the market infrastructure, European market infrastructure. So I think what we need to do is really to accelerate now. We can't just wait 2028 to start building or to amend the DLT pilot regime. It's both a legal work and at the same time start building.
So if we extend the licensing of the DLT pilot, remove the caps, do you think that as an intermediary solution that could get us into a kind of sufficiently scaled market within the DLT itself, or without the kind of increased speed of the work on Appia, this is not happening? Or MiCA 2.0 plus an updated DLT regime could be sufficient as an intermediary solution?
I think what we're missing when we say Appia is we all know what we have to do, but we have no clue who's going to do it. And I think we need to determine who's going to do that cooperation now. It's not only the sponsor, but also the team doing it, actually.
And so in terms of the speed, Kim, and the kind of the need to act fast, what would be the thing that you want to see most want to see happen in 2000 by the end of 2026 to see the market moving forward in a meaningful way, if you had to choose one or two rather than 10?
Yeah, I think it's a tight timeline, to be honest. But nevertheless, I would agree with what Michael said. We see a lot of US companies, a lot of US asset managers also already having live products out there. I think there was a lot of involvement in the fund industry also from European players recently. So I think we're moving into the right direction. And I would say, like my one wish or my hope would be that we see more fund issuances also out of Europe by end of the year. And then also what I mentioned earlier, that we keep in mind what our clients need. It's not just about the issuances itself, but it's about bringing benefits to the clients in the end and enabling these new use cases and new features.
And do you have on top of your mind that what are the biggest asks from the client side in terms of what they need or what they're looking for in asset managers?
I think at the moment, we're still moving a lot in the money market fund space, I would say. There's the liquidity point that was mentioned, I think, on earlier panels here as well. And then I think features like peer-to-peer transfer, self-custody, especially if we're targeting these new client groups, these will become essential features. And then obviously settlement in digital money.
Thank you. And so coming to the institutional question, maybe closing with that as we're slowly running out of time, Guillaume, what do you think are the main institutional objections that remain today to moving towards a tokenized market that's scalable in Europe?
I think we have a legal issue so far, so we need to progress on the legal infrastructure. You're asking me the bottlenecks basically that we need to fight today. So legal infrastructure, which is a big problem so far. What could I say?
So it's certainty on the side of institutions that they don't want to start investing into something that they don't know how the regulators will.
Banks need to know exactly where, when they issue a token, basically, whether in which settlement it's going to happen, where is the settlement going to happen, what is a security compliant with the regulation, etc. So, if I would say the main issue is the legal infrastructure issue for the time being.
Thank you, and we're slowly running out of time. So I think that thank you for a very interesting discussion that I think shows that tokenization obviously does matter, but more in terms of how do we get to a real European market that works within the frame of monetary sovereignty and real competitiveness on the global scale. So thank you for the discussion, and thank you to the organizers once again.